Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 12th of January 2015, our first video update for the year. As always, before taking a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than our Hurst Trading Room podcast channel, then make sure you subscribe to that channel because you will be notified of any new videos as I record them. And there's something else I'd like to invite you to do this week, and that is to join the conversation. Over the years, as I've been speaking about Hurst cycles with other Hurst cycle analysts, I have witnessed a growing community of people who analyze and trade the markets using Hurst cycles. A very big question that many newcomers have is how can we get involved in the conversation? How can we ask questions of people who are more experienced than us? And you know, we've tried everything over the years, from forums to online chats and all kinds of things. One of the issues with forums is that people who have questions tend to go to forums, whereas people who have all the answers tend to be so busy analyzing and trading the markets that they don't spend time in those forums. We are testing a new way of enjoying a Hurst Cycles conversation, and that is something called Spot IM, Spot Instant Messaging. You will notice at the foot of each one of our websites, whether it's Hurst Cycles or Sentient Trader or your Hurst Trading Signals dashboard, you'll see there is a small circle. Simply click on that Spot IM circle and please get involved in the conversation. Whether you would like to share your opinions about what is happening in the market, or whether you have questions or answers, please get involved in the conversation. Let's take a look at the markets, and I would like to discuss what's happening in stock markets around the world. This is a chart of the S&P 500. Remember that, of course, stock markets around the world move with a great degree in common. That's Hurst's principle of commonality. And what happens in the US markets tends to happen in a similar manner in the European markets. In my opinion, the European markets have turned bearish sooner than the US markets, but the US markets are probably in the process of turning bearish, and that's why this is a really important update in my opinion. We need to keep an eye on what's happening in those markets, and we've been enjoying a very long bull run. As you can see on this chart, the markets have been going up and up and up. I suspect that they are going to stop going up and they are going to start turning down. And of course, we need to bear that in mind as we make our trades. First of all, let's just remind ourselves about the general situation. Here is the long-term chart of the S&P 500 with a very prominent trough, of course, in 2009. Now, that trough was almost certainly a trough of at least 54-month magnitude. In other words, the 4.5-year cycle formed a trough at that point. I suspect that the 9-year cycle also formed a trough at that point, potentially even the 18-year cycle, but let's not discuss those very long cycles at the moment. The important thing is that I believe the markets are approaching a 9-year cycle peak. Let me draw a semicircle here for the 9-year cycle. That's a very rough, very poorly drawn semicircle, and of course the 9-year cycle peak, the actual cycle peak, is almost certainly behind us. We've seen 6 years since the 2009 trough, and 6 years out of the 9-year cycle, we're well past the midway point, and so the actual peak of the cycle has almost certainly happened. But the important thing is I'm speaking about where the peak is forming in the market itself. You will know that both peaks and troughs are time translated. In other words, they don't occur in the markets at the exact time that the cycle itself forms the trough or the peak. It's a very important and fairly subtle point, and sometimes it confuses people. There are cycles that influence the financial markets. We don't know what those cycles are, but those cycles obviously form troughs and peaks. And they influence financial markets to also form troughs and peaks. Now, those troughs and peaks in the actual financial market or in the price movement will be time translated. It will be displaced in terms of time from the actual peak in the cycle. So the peak of the 9-year cycle has almost certainly occurred. It is behind us. But the peak in the 9-year cycle in the price movement of the stock market has possibly formed recently. Perhaps it still lies ahead of us. Some analysts might argue that it still lies ahead of us. But I've been speaking about the peak of the 9-year cycle forming in the stock markets for some time now. It's something I've been expecting. I've been monitoring the markets carefully. And the subject of this video really is the fact that I believe there are some bearish signs that are appearing, which would seem to indicate that the markets are in the process of turning down, which is of course what we are expecting, and that potentially that 9-year cycle peak has formed in the market. That means we're going to be looking at a bearish market for the next 2 years probably, at least, if not for some time after that. So it's a really important moment in the markets, and we need to be very careful about the trades that we are making. Now let's speak about the formation of the 9-year cycle peak in the market. Of course, the 9-year cycle breaks down into two 54-month cycles. There was the first one, and we are currently in the second 54-month cycle. And so the peak of the current 54-month cycle will, of course, be the peak also of the 9-year cycle. And so the question is not so much when is the peak of the 9-year cycle going to form, but when is the peak of the current 54-month cycle going to form. Now, each 54-month cycle, and let me just clear that, and perhaps let me zoom in a little bit on this chart so that we can focus on this 54-month cycle. There we go. Each 54-month cycle breaks down into three 18-month cycles. There's the first one. We are currently in the second one, in my opinion, and then of course there will be a third 18-month cycle taking us down into the trough of the 54-month cycle. Now, when do we expect the peak of the 54-month cycle to occur? I expect it to occur in this central 18-month cycle. The reason for that is because I believe that the 9-year cycle has turned down, as I've indicated, and the 54-month cycle is fairly neutral round about this point. So therefore we have a slightly bearish but perhaps neutral underlying trend for the 54-month cycle, and therefore I expect the peak to occur in the central 18-month cycle. It's an expectation, it's not absolute science, but it's what I expect to happen. Where do I expect the peak in this central 18-month cycle to occur? That's this period over here. Where do I expect that peak to occur? Well, again, because of calculations involving underlying trend, I expect the peak to occur probably within the first 40-week cycle. And we can continue that logic. I won't bore you with the details, but I continue that logic and expect the peak of the 54-month cycle to occur within the first 20-week cycle, which is the cycle that we are currently in the stock markets, and it is a cycle which is expected to form a trough probably March or April of this year. So when the peak of that 20-week cycle occurs, that is likely to be the peak of the 9-year cycle. That's a really important big moment, and so we need to be very careful, because it would signify that the markets are tipping over into a bearish mode, and we're going to start seeing profitable trades only on the short side and not on the long side. It's not going to be an instant process. It's not going to suddenly happen overnight, but we need to watch for those bearish signs. And in particular, we need to watch for the formation of that 20-week cycle peak. Now, it is possible that that 20-week cycle peak has occurred. And what I would like to do is highlight some of the bearish signs that have started appearing in the markets, which are signs that we must pay attention to, and which potentially mean that we need to focus on entering into short trades as opposed to long trades. Let's take a look at a little more detail. Actually, before we take a look at the detail, let me quickly show you a chart of the DAX. This is the German market, of course, And this simply serves to illustrate my point about the principle of commonality, which is that stock markets around the world move with a great degree in common. And so here you can see the same analysis. There is the 54-month cycle trough, which occurred in March of 2009. And here we see the two 54-month cycles. We're currently in the second one. The 9-year cycle, of course, will have done something like that, and so therefore the 9-year cycle is probably already turning down. You can see, I'm sure, simply by looking at this chart, that the bull market that has been driving the US markets is not as strong in the DAX or in the European markets generally. And I wrote on the Hurst Cycles blog about the fact that the FTSE, the British market, seems to have already developed some fairly strong bearish tendencies. And so the bear seems to have arrived first in Europe, and in my opinion, it is now spreading over the oceans to the US markets. So let's take a look at that detail in the US markets. Here is the daily chart of the S&P 500. And of course the 18-month cycle trough in the middle of October of last year. And towards the end of last year, I was speaking about the markets coming down into an 80-day cycle trough, which of course they did, and it formed on the 16th of December 2014. That is the 80-day cycle trough, in my opinion. And since then, we saw a good, strong bounce out of the 80-day cycle trough, which took us to just after Christmas. Then price came down again, and something very important happened. So I'm now going to go through the reasons why this market is beginning to look bearish. First of all, the market came back down to the 20-day FLD. Now, you will know that I trade the interaction between price and the 20-day FLD, and I trade a sequence of interactions. That sequence I label from A through to H. The first interaction following an 80-day cycle trough, there's the 80-day cycle trough in the middle of December. The first interaction I label a category A interaction, and I expect price to continue up and to achieve a target equidistant from the 80-day cycle trough to the interaction with the FLD. Now, the first thing that can very easily be seen on this chart is that the A category trade did not achieve its target. We can simply count the grid lines here, although they're very faint, but that's about 1 3/4 grid lines from the level of the trough up to the level of the interaction with the FLD. If we count 1 3/4 grid lines further up, we're off the top of the chart over there. So the first bearish indication that we received from the markets was the fact that the A category trade or A category interaction between price and the FLD failed to achieve its target. That is a significant sign. Usually the A category trade easily achieves its target. Here's the previous A category trade bouncing out of the trough in the middle of October. There is the interaction with the FLD, and you can see that the target was easily achieved. Somewhere over here, we call that T2, of course, but that's the target of that A category trade. So that's our first bearish sign. The next thing that we expect is for price to come back down to the FLD in the B category interaction, and we expect price to find support at the FLD. Now, let me clear the chart and draw a very quick diagram over here of the way in which we expect our interactions with the FLD to occur. There's our M-shaped cycle, and here is the A category interaction. I won't draw the FLD because this drawing gets a little complicated if I do that, but here is the B category interaction as price comes back down towards the FLD, C category interaction as it bounces away from the FLD, and here is D, and here is E, and here is F, and G, and H. In fact, I'd better draw that FLD because it's a bit confusing without it. So there is the FLD as well. Okay, that dotted line is the FLD. That's a very rough diagram, but those are the interactions that we expect between price and the FLD. Now, that is in a balanced market. In other words, it's not a very bullish market, it's not a very bearish market. And when the underlying trend or the combination of all the longer cycles is fairly neutral, in other words, we have some cycles pushing up and some cycles pushing down, then we do see this very balanced picture. The interactions between price and FLD pretty much follow this diagram very reliably. When the market is bullish or stretched to the upside, then all of our interactions are also stretched to the upside, and you can see an example right here on the S&P 500. Our previous 80-day cycle was a fairly bullish cycle, which is to be expected because it was the bounce out of an 18-month cycle trough. So we had several cycles that were all pushing up. As you can see, you simply count the diamonds above the 80-day cycle. There's the 80-day cycle diamond back in October, and if we count those diamonds, there's 1, 2, 3. Three diamonds, in other words, 3 cycles that formed a trough at the beginning of that 80-day cycle, and therefore those cycles were all pushing up. And so therefore we would expect a bullish 80-day cycle, and that's exactly what we got. What happens when we have a bullish 80-day cycle is that the interactions between price and the FLD tend to get stretched to the upside. And here you can see there's the A category interaction, very stretched to the upside. The B category interaction was probably somewhere over here, also very stretched to the upside. Notice price didn't even come down to the FLD. It didn't reach the FLD. There's the C category interaction, also stretched to the upside, right? We get a nice, good bullish move. The D category interaction was over here. Did price drop down below that FLD? No, it didn't. It came down and only touched it. And so that's, again, an interaction that has been stretched to the upside. The E category interaction, as price bounced out of the 40-day cycle trough, was also stretched to the upside. We saw another good move upwards. Here's the F category interaction, a very small, slight interaction. G, as price came back up to the FLD. Again, everything being squeezed upwards because that bull is pushing it up and up and up. Here's the H category interaction as it came down to the 80-day cycle trough. Now, that was a fairly surprising move because suddenly there were some bearish signs. We'd been witnessing tremendous bullish pressure all the way through that cycle, and the bulls started letting go in the beginning of December for that H category interaction, which turned out to be a very good short interaction, a very good short trade that occurred over there. So that was an 80-day cycle that was skewed to the upside, to the bullish side. Now, what are we seeing here in the current 80-day cycle? Well, first of all, as I've mentioned, we had the A category interaction which failed to reach its target. That's the first bearish sign. So the fact that it failed to reach its target, the A category trade, is a bearish sign. Then price came down to the 20-day FLD. Now, as I've just spent some time explaining, we expect price to provide support in the position of a B category interaction. That's over there. We expect the FLD to provide support to price. What happened just after Christmas and just before the new year, I think that is, price came down to the FLD, but instead of the FLD providing support, price plunged straight down again. That is another very bearish sign. When the FLD fails to provide support at the position of a B category interaction and price instead plunges down through it, that is a very bearish sign. Of course, we now expect a C category interaction, but we are beginning to see bearish signs. So what is my expectation? I am not feeling very positive about what we're going to see from the C category interaction because we have already seen 2 bearish signs developing in the current 80-day cycle. I might be surprised and see price suddenly bouncing up tremendously. I expect it to bounce up, of course, but I don't expect it to be a very bullish interaction. If it doesn't develop into a very bullish interaction, then that would be a third check mark against the bearish list. So what I'm seeing here is the beginning of some bearish signs. Now, let's speak about something else, the VTL, the valid trend line. We don't often speak about valid trend lines because, of course, I'm trading mostly the interaction with the FLD, but valid trend lines are very useful cyclic tools, particularly for giving us information about what's happening in the cycle picture. And that VTL, or valid trend line, that I have just plotted on the chart is the VTL for the 80-day cycle. Notice that it joins the two consecutive troughs of the 80-day cycle. Okay, and therefore it is a trend line which is related to the 80-day cycle. Now, notice what happened last week. Price came down to the VTL, dropped below it on the Tuesday, and then bounced back up again. Now, that might have been a temporary aberration. It might have been a little bit of extra noise in the market, a bit of fundamental interaction. But if you are going to be a stickler for the rules, then you should know that that VTL has been breached. According to the rules, when price touches a VTL and crosses a little bit below it, and it did cross only a little bit below it, but it did cross below that VTL, that tells us that that VTL has been crossed, it has been breached. What does that tell us? That tells us that the peak of the 20-week cycle has formed in price. Now, where is the peak then of the 20-week cycle? It is here, of course. It is the peak that formed, was that between Christmas and New Year. That is the highest price that we have seen in the current 20-week cycle, and therefore that is the peak of the 20-week cycle, according to the fact that the price has dipped down below that 80-day VTL. Now, before I bring this video to a conclusion, let me just point something out here. Over the years, I've watched price coming down to VTLs, and I found the VTL a very useful tool, but it is not the most reliable tool. I trade the 20-day FLD and many other cycle FLDs, of course. I trade the FLD because it is my tool of preference, if you like, and that is because the VTL is not quite as reliable, but it does provide us with interesting information, and so I tend to take that information with a pinch of salt. It is very possible that that 20-week cycle peak has formed, and the fact that price dipped down below the VTL is telling us that that is the case. But occasionally that information proves to be premature. Occasionally price crossing or touching the VTL proves to be a false signal. So I'm not going to put all my eggs into that basket because prices touched the VTL, but it is certainly a very worrying sign, and it is another bearish sign. And so let me wrap up this video by drawing a conclusion about what is happening. Recently, over the past few weeks, we have seen some worrying bearish signs. I've highlighted three of them. The fact that the A category interaction between price and the FLD did not reach its target was the first worrying sign. The second worrying sign was the fact that the FLD did not provide support at the level of the B category interaction. That is still a B category interaction, make no mistake. It is a B category interaction, but it was a particularly bearish one, and it was a bearish sign. The third bearish sign that we have seen recently is the fact that price has breached that 80-day VTL to the downside, indicating that theoretically the 20-week cycle peak has formed in the markets. Now, let me zoom back out again and remind you of what I said earlier in the video, which is that in my opinion, I believe that the 9-year cycle peak is going to occur when the current 20-week cycle peak occurs in the market. And I said this way back in September or October of last year. And at that time, I said I was looking for a peak to form early in 2015, possibly around about March. But I also have just said to you that the fact that price dropped down below the 80-day VTL provides us with evidence that the 20-week cycle peak has already occurred, and it is the peak that we witnessed between Christmas and New Year. If indeed that is the case, then we have now seen the peak of the 9-year cycle form in the markets. I'm not going to immediately go bearish on everything, but it is yet another worrying bearish sign. And so I think that we need to start preparing ourselves for the fact that these markets are turning bearish. Remember, all you need to do is keep a very close eye on the cycle shapes that are forming in the markets. Keep a close eye on those cycle shapes, and you can be confident that you will be making trades in the right direction. Thank you very much for joining me this week in the Hurst Trading Room. I look forward to seeing you next week, and I wish you, as always, profitable trading.